the biggest lie every gold trader was taught. For years, I believed that price action alone could reveal where gold was going next. But after thousands of hours studying the market, I discovered something that changed everything. The candles were never leading the move. They were simply reacting to forces that had already begun inside the US macro data. Imagine you're driving on a highway while only looking through the rearview mirror. That's what trading gold with price action alone can feel like. You're making decisions based on where price has already been instead of understanding why it moved in the first place. When the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY begin shifting, institutional traders are already repricing expectations for interest rates, inflation, and the US dollar. By the time a textbook price action setup appears, a significant part of the move may already be underway. Most losing traders are not losing because they lack another indicator. They are losing because every trade becomes a decision based on uncertainty, emotion, and the fear of missing the next big move in gold. When traders understand the relationship between the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY, they create a logical framework before entering a trade. Instead of asking, should I buy or sell because of this candle pattern, they begin asking, what is the market expecting from interest rates, inflation, and the US dollar? A trader can find the perfect support level, a beautiful candlestick rejection, and a textbook price action setup on the chart. But if the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY are sending a completely different message, that perfect setup can become a trap. This is where many traders get confused. They think their analysis was wrong, but the real problem is that they only studied the movement of gold without studying the forces influencing that movement. The biggest difference between struggling traders and professional traders is not the ability to draw more lines on a chart. It is the ability to understand probabilities and build decisions around the environment that controls the market. Institutional traders do not ask, what pattern do I see on the chart? They ask, what is the market pricing in? The movement of the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY helps them understand expectations about interest rates, inflation, and the strength of the US dollar before they commit capital. FOMO is one of the biggest reasons traders lose money in gold. They see a huge candle move, they enter late, and they hope the market continues in their direction without understanding what is actually driving the move. A macro-driven trader behaves differently. Instead of chasing a candle after it moves, they monitor whether the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY are confirming the direction. If the data does not support the move, they have the discipline to wait. The biggest mistake many traders make is believing that the chart itself is the entire market. They study every candle, every pattern, and every formation, but they forget that the chart is only the final result of millions of decisions made by investors, institutions, and central banks. The movement of gold is connected to expectations about interest rates, inflation, and the strength of the US dollar. That is why monitoring the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY gives traders a deeper understanding of the forces behind the price movement. Consistency in gold trading does not come from finding a magical indicator or the perfect chart pattern. It comes from following a repeatable process that explains why the market is moving and gives you a logical reason to participate or stay away. When traders analyze the relationship between the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY, they create a framework that reduces random decisions. Instead of entering trades because of excitement, fear, or a sudden candle movement, they wait for conditions that match their. The journey of becoming a better gold trader begins when you stop searching for the next signal and start understanding the forces moving the market. Price action can show you what happened, but macro data can help you understand the environment that created the move. The relationship between the US 2-year Treasury Yield, US 10-year Treasury Yield, US 10-year TIPS, and the DXY gives traders a bigger picture beyond a single candle or pattern. If you want to learn how to build a more structured approach to analyzing gold, continue your journey with us at thelaxons.net.